everybody, Nate here, and the Federal Reserve just said a recession is coming this year due to the recent banking crisis. In its minutes report for March, the Federal Reserve said that the collapse of Silicon Valley Bank, Signature Bank, and the subsequent government takeovers may lead the United States economy into a mild recession this year, and that because of it, the Federal Reserve may need to pull back on its interest rate hikes. And they're not the only ones saying that. Even Goldman Sachs raised its predictions that we could see a recession this year by 10 basis points after the collapse of Silicon Valley Bank and Signature Bank. Now, the likelihood for a recession in the United States could be determined by two major factors. We're talking about the banking sector and inflation. Banking sector has caused massive problems in the United States economy before, like the banking and financial collapse of 2008, when we saw the largest bank in United States history, Washington Mutual, go under. Well, just a few weeks ago, we saw the second largest bank in United States history collapse, Silicon Valley Bank, and that created waves throughout the entire financial sector. Basically, what you had there was a big liquidity problem. So the bank ended up not having enough money to give back to its depositors who were going to the bank asking for all of their money back. Banks in the United States work on a fractional reserve lending system. So basically, they only have to keep a fraction of their depositors' reserves on hand at all times. They then take the rest of their depositors' money and go out and invest it or give it back to lenders. So when people go back to the bank and ask for their money, the bank has a lot more money to give because that money is well invested and they're getting all of this money back through interest payments on all of their loans. But that's not what happened with Silicon Valley Bank. Silicon Valley Bank ran into problems because it was over leveraged on a ton of different assets that were losing value due to Federal Reserve interest rate hikes. It was then posting huge losses, and that scared consumers who then ran to the bank to pull all of their money out. That then scared a lot of other consumers in other banks who pulled collectively $100 billion worth of their deposits out of local and regional banks. And the issue is a lot of those deposits are completely uninsured, meaning that if the bank was to go under, well, a lot of that money is going to go away and it's going to completely disappear. The FDIC then came in and said they were going to insure all bank deposits and depositors of all of their money back. But that government backstop is not going to survive forever. And the fear is that a lot of other banks could end up collapsing due to the fallout of Silicon Valley Bank and Signature Bank. I don't have every single bank balance sheet in front of me right now, but what I can tell you is banks want to invest in things that are going to make them money. Right now, nearly every single asset class is losing value, which means a lot of the investments that banks have made, both large and small, well, they are losing money here, and a lot of them are posting losses. And this is sort of a big rotating problem because what you have here in the United States is banks who are kind of scared about economic conditions, and they're scared about potentially taking on too many losses that they're not lending out as much money to consumers or to businesses. They're getting a lot stricter with their lending standards, and that means that businesses might not be able to get the capital that they need to survive, which means they can't hire employees, which means those employees can't pay for things like a mortgage, or they can't buy consumer goods and services or food or anything else that they need. Wherever consumers are spending their money, well, now those companies can't grow because consumers are pulling back spending even more. Not to mention, if we start to see regional banks like Comerica Bank and Fifth Third and First Republic Bank go under, then that means that businesses are not going to have the money that they need in order to pay their employees or just run their business in general. And like I said, if you have deposits lost, then that means consumers don't have any of their savings anymore. This could mean tens of thousands of dollars eventually disappear. Now, this could end up translating into a recession because at the end of the day, you have less money going into the system. Investors investing a lot less money, which means less liquidity for businesses. And then you have consumers spending a lot less money because they simply can't get a mortgage or an auto loan, and they can't spend on a credit card because the interest rates are way too high. Not to mention, if you have consumers who currently have a mortgage or an auto loan and they can't get money from the bank, or they can't get a job because businesses aren't hiring right now because businesses can't get money through loans, then that means they could default on their loans, and that affects banks too. And it also affects Wall Street because Wall Street has a ton of money tied up in all of these different loans. We saw that happen happened during the 2008 Great Financial Crash, because when millions of Americans defaulted on their adjustable rate mortgages, well, that affected the mortgage-backed security market, and all of the investors and banks had pumped trillions of dollars into that market. Well, all of those assets essentially went to zero and everybody lost everything. And the issue is, this is already starting to happen across the board because banks are starting to realize that Americans are defaulting on their mortgages due to rising prices and inflation. Businesses with their commercial real estate loans are also starting to default on their mortgages. Fewer people are able to qualify for credit and fewer businesses are able to get by right now, and we're starting to see bankruptcies go up, mergers increase as investors pull back and startups just don't get the money that they need to survive. And that has led to hundreds of thousands of layoffs all throughout the United States in nearly every sector. Like I said before, if people don't have money, then they're not going to be able to pay for everything, and that affects the banks, that affects investors, that affects you. That is what's known as a credit crunch, and that is exactly what the Federal Reserve believes is going to come from this banking crisis right now. There's going to be banks that end up shutting down. The government backstop is not going to be enough, and that means that they're going to have to do something in order to prevent an entire economic meltdown. But the Federal Reserve and the government only has a few options here. A backstop wouldn't be enough, so they may have to go into a full-on bailout, which could mean printing hundreds of billions of dollars and purchasing a lot of the bad assets that these banks have in order to give them the liquidity to ensure deposits. Or the government may end up taxing you in order to get the revenue that it needs to bail out a lot of these banks. Otherwise, it could just let banks fail, and that could lead to a systemic failure throughout the economy and an ultimate recession. Now that is the banking side, but now let's switch over and talk about inflation and its role in all of this. The reason banks are having a lot of issues is because they over-invested and invested a lot over the last couple of years. But now that the Federal Reserve is raising interest rates, well, people can no longer afford their loans, neither can businesses, and all of the assets that banks have bought, well, now they're going down in value. If people run on banks and try to get all of their money out all at once, well, now the banking sector goes down, and like I said, you've got a huge problem. But what you're probably thinking is, well, if interest rates are the problem and they're too high, then why doesn't the Federal Reserve just lower its interest rates? Well, the Federal Reserve could do that, but it's trying to fight inflation right now, and getting inflation down is its #1 concern. You see, inflation simply means that the value of your money is going down. So that means the buying power is a whole lot less, and Americans need a whole lot more money in order to buy all of the same things. Like, for instance, I went through the drive-thru at McDonald's the other day, and a pop that used to cost $1.06 now costs around $1.39, and this is just over the last year or so. That is a huge increase, and if it's everything across the board, that means I now need to make a lot more money in order to afford all of the same things. But that creates a problem though, both for Americans and the entire United States government. The more dollars that are out there, the less valuable a currency is. So you can't just keep printing and printing and printing and having hundreds of trillions of dollars out there, because your money is going to be worthless. That is exactly why countries like China and Russia and India and Brazil right now are all working together in order to subvert the United States dollar and create their own reserve currency. Because the United States dollar is the most valuable currency on the planet, well, that means pretty much every country wants to hold on to it and use it as an exchange for trade. But if the US dollar continues to lose value, then that means all of the assets that China has in US dollars and all of the savings it has, well, all of that savings goes down in value, which is bad news for their country. That is exactly why they have been trying to get rid of United States debt, and they don't want to invest or do business in US dollars anymore. That could mean the United States eventually loses its status as the world reserve currency, and that creates a whole lot of problems, something that the Federal Reserve is trying to avoid by continuing to raise its interest rates. Not to mention, here in the United States alone, well, it creates a lot of problems for our own consumers, because if somebody doesn't make enough money, well, then that means that they need to get a raise at their job. Once they get a raise, they can go out and buy a whole lot more things, but now companies need to compensate and make a lot more things, but that comes at a cost. They then then have to pay more to create more factories or to hire more workers, and eventually they trickle those costs on down to the consumer. So that way the consumer can fund all of these new products, but again, with rising prices, consumers don't make enough money. This is called the wage price spiral, and it can get out of hand if prices are not under control in an economy. So in order to prevent people from just making a lot more money and buying more things and companies just raising prices, the Federal Reserve raises its interest rates in order to lower demand. Now it's a whole lot harder for people to borrow money, for people to spend money, and that is exactly what the Federal Reserve wants here. So far, as of the most recent inflation data that we have, this is working. The Federal Reserve has made demand go down enough to where people can't buy as many things, and inflation is now at around 5%. But keep in mind here, that is still way higher than what we need it to be in order to have a sustainable economy. The Federal Reserve likes to keep it at around 1 to 2%. But to answer the original question, why doesn't the Federal Reserve just lower its interest rates? Well, that is something that it is looking at right now. The Federal Reserve might be forced to lower its interest rates if the United States economy enters a recession, because if the US is in a recession and banks are having a really hard time loaning to anybody, well, now pretty much nobody, including businesses, can spend any money, and that is a serious issue. That could lead to mass unemployment, and it could lead to thousands of businesses shutting down. So the Federal Reserve doesn't want to see that, so it has to be very careful what it does next with its interest rate policy. Many Fed governors in the March meeting actually said that the Federal Reserve should pause interest rates, but they ended up raising them by around 0.25%. That is because the end of the US dollar as the reserve currency of the world and inflation continuing to go up is a much bigger issue right now to the Federal Reserve than a potential recession. And with that all being said, that is exactly why the Federal Reserve may end up causing a recession this year. If they were to just lower their interest rates now, well, that could mean inflation just goes right back up. It means people are going to borrow money. It means that people are going to spend a lot more money. And right now, the Fed needs to keep prices under control. Now, to put the two together, what the United States economy is headed for next is really high interest rates and also some banking problems. And those two issues together could cause a recession. Basically, it's hard enough right now to borrow money because Federal Reserve interest rates are really high, but because banks are in crisis mode, they are making it extra hard for people and businesses to borrow money as well, which means no economic output whatsoever. Now, I don't have a crystal ball in front of me, and I can't tell you if the banking crisis is going to cause a recession, or if the Federal Reserve is going to cause a recession, or if we're even going to see a recession this year. But what I can tell you is that financial education and knowing what to do with your money right now is more important than it pretty much ever has been. Whether we see an economic boom or bust, you need to know how to handle your money, you need to know how to save your money, and you have to stay in the know with everything going on in the business and financial world. That is exactly what we're talking about 7 days a week over here on this channel, so if you haven't subscribed yet, be sure to do that before you go. And if you want to stay even more updated on everything that is going on across the world, I'm talking global economy, I'm talking cryptocurrency, you name it, we are talking about it over on Market Briefs, and you can subscribe for free by clicking the link in this corner right here. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.